Greetings to you all and welcome back to the lesson. The subject is Advanced Financial Management. Today we are going to answer question 2 from the December 2023 sitting. In our last session, we answered question 1. Today we answer question 2. Question 2 is in two parts, A and B. Part A reads, Economic and Monetary Union was formulated by European leaders. On 1st January 1999, the new European currency, the euro, came into being. From that date, there was to be no change in the exchange rates of the member countries. Euro notes and coins were introduced into circulation on 1st January 2002. Dual circulation of the euro and the legacy currencies of each country continued for a short period of time. Thereafter, participating countries have only used euro notes and coins. Required, in regards to the above statements, explain 6 reasons or arguments in favor of the economic and monetary union. 6 marks. In regard to the above statements, explain 6 arguments in favor of economic and monetary union. What are the arguments in favor of the economic and monetary union? Now, the first favor or argument in favor of the economic and monetary union, number 1, is the economic stability. EMU led to economic stability, enhanced economic stability. Such a union leads to enhanced or increased economic stability. EMU has promoted stability by eliminating currency exchange rate fluctuations among the member countries, and that stability reduces uncertainty for businesses and investors, and thereby fostering confidence and encouraging long-term investment and economic growth. So EMU has led to enhanced economic stability in Europe. It has also facilitated trade and investment. EMU has facilitated trade and investment because candidates having a single currency simplifies cross-border transactions. Having a single currency reduces transaction costs and administrative burdens associated with currency exchange, and that facilitates trade and investment among the member states or countries, which then leads to increased economic integration and efficiency. So that is the second reason or argument in favor of the economic and monetary union. Facilitates trade and investment. So investment flows easily among the member states because of the barriers or the burdens associated with the exchange rate. There is also what we call price transparency. Price transparency. Price transparency and competition. This is yet another argument. With a single currency, candidates, consumers can easily compare prices across different countries and thereby fostering price transparency and competition. And that encourages businesses to improve efficiency, to improve competitiveness, and also to attract customers, ultimately benefiting the consumers through what we call lower prices and better quality goods and services. So a single currency promotes price transparency and competition among the member states. 4, there is also an argument related to monetary policy. Monetary policy coordination. Monetary policy coordination. EMU allows for greater coordination of monetary policy among member states through the European Central Bank. And such coordination candidates enables policymakers to respond more effectively to economic challenges, to economic shocks, such as inflation or recession, thereby ensuring a more stable macroeconomic environment across the Eurozone, across Europe. Number 5, reduced currency risk. A single currency reduces what we call currency risk. By adopting the euro candidates, member countries eliminate currency risk for businesses and individuals engaged in cross-border transactions within the Eurozone. And that reduces exposure to currency fluctuations, making it easier to plan and conduct business activities across the national borders. Then lastly, increased foreign investment. The EMU increased foreign investment. EMU can attract foreign investment by creating a large and stable economic bloc with a single currency. And therefore, foreign investors may find the Eurozone more attractive due to reduced currency risk, due to enhanced economic stability, due to increased market access, and so on. So there is the inflow of foreign investment that can contribute to economic growth and job creation within Eurozone. Within Eurozone. So these are 6 arguments in favor of economic and monetary union. Candidates were to give 6 to earn the 6 marks. The first argument is in relation to economic stability. Number 2, it facilitates trade and investment. Number 3, EMU led to or leads to what we call price transparency and competition. Number 4, monetary policy coordination. The other argument is in relation to currency risk. And lastly, foreign investment within Eurozone, 6 marks. Part B reads, Daniel Wekesa, an investment specialist, has been entrusted with 5 million by an investment club and instructed to invest the money optimally over a 1-year period. Part of the instructions are given as follows. Number 1, the funds be invested in one or more of the 3 specified projects and in the money market. Number 2, the 3 projects are not divisible and cannot be postponed. Number 3, the investment club requires a return of 14% per annum. Number 4, the following details relate to the projects and money market. So we have the information on project 1, project 2, project 3, and the money market. We have the initial outlay for each project, the forecasted rate of return for each project, and the expected standard deviation for each project. Number 5, the correlation coefficients of returns of the above combination of projects are as follows. So we have combination P1, that is project 1, and P2, project 2. Then there is combination P1 and P3 and combination P2 and P3. Then there is information between projects and market portfolio. These are correlation coefficients of returns between projects and market portfolio. We have information on the correlation coefficients of returns between projects and money market. Then lastly, we have the correlation coefficients of returns between money market and the market portfolio. Additional information: number one, the risk-free rate of return is 12%. Number two, expected return of the market portfolio is a weighted average return. Given below are forecasted rate of returns from a market portfolio and their profitability of occurrence in different states of nature. So we have the state of nature known as recession, average, and boom. The probabilities are 0.3, 0.4, and 0.3 respectively. The forecasted rate of return are 10%, 15%, and 20% respectively. Required: evaluate how Daniel Wekesa should invest the 5 million shillings using Roman 1, capital market line analysis in portfolio theory, and Roman 2, capital asset pricing model, 7 marks each. That is the question. I want you candidates to go through the question again on your own, then go through it another time so that you understand the question well. And the question tested the candidate's knowledge on two things: the capital market line and the capital asset pricing model. Now, candidates, the capital market line is a fundamental concept in finance. It is a fundamental concept in finance that illustrates the relationship between risk and return for efficient portfolios within a given market. You understand? So it's important to underline efficient portfolios. You can see here we have 3 portfolios. In note number 5, the projects are P1 and P2, P1 and P3, P2 and P3. We may also have P3 from note number 4, P3 and money market. So those are the possible combinations. Remember the instructions. The maximum investment here is 5 million. The 3 projects are not divisible and cannot be postponed. And the funds can be invested in one or more of the 3 specified projects in the money market. So you can see in note number 4, project 1 is 3 million, project 2 is 2 million. So that is a possible combination. In the same note, you can see project 1, which is 3 million, and project 3, which is 2 million. That gives you a total of 5 million. That is the second possible combination. Then we have project 2, which is 2 million, and the money market, which is 3 million. That's another possible project combination. And lastly, we have project 3 and money market. That's another project combination. So candidates, the capital market line illustrates the relationship between risk and return for efficient portfolios. And to make a decision, because we have to evaluate how David Wekesa should invest the 5 million. The question now is, how are we going to carry out this evaluation? Now, using the capital market line, candidates, we are required to calculate what we call alpha. Alpha. All right? We'll be guided by alpha. All right? Alpha. Now, candidates, alpha represents the additional return earned by a portfolio beyond what would be expected given its level of risk as measured by beta. And alpha, candidates, is calculated as, this is the symbol for alpha. Alpha is calculated as the difference between the expected portfolio return, portfolio return, and the minimum required return, and the minimum required portfolio return. The minimum required portfolio return. So do you understand, candidates? So alpha is the difference, and this shows the excess. Alpha represents the additional return earned by a portfolio beyond what would be expected given the level of risk as measured by beta. So we are going to calculate the alpha for each portfolio, for each combination, and the one that will register the highest alpha is the best portfolio to invest in. So alpha, in other words, candidates, indicates the portfolio ability to outperform the market or to underperform the market, which is on a risk-adjusted basis. So that's very important. That is the formula, candidates. We are going to calculate the alpha for each portfolio. So you'll have a table here, one acceptable portfolio, one column for the acceptable portfolio. Then you'll have another column for required portfolio return. The required portfolio return. Another column will be on the expected portfolio return. Then we'll have the alpha, which you have said is equal to the expected return on portfolio minus the minimum required return. So that will give us the alpha. Then based on this alpha of the different combinations, we will advise what project to invest in, what portfolio to invest in, what the right combination of projects. For that, this is the formula. So candidates, when faced with such a question, it's important first of all to put down the formula. This is the formula. By formula, I mean the approach. This is the approach we are going to use in answering this question based on the capital market line. So anything else you are going to work out, candidates, are just what we call workings. So we are going to have our workings here. Now, candidates, going back to the question, we have in note number 4, the details related to the projects and the money market. And we've defined CML as a concept in finance that illustrates the relationship between risk and return for efficient portfolios. Efficient portfolios. So in our next phase, we are going to work out or determine the efficient portfolios from the information provided in note number 4. So we're going to have here a column for asset portfolio, the possible combination. From note number 4, you can see the maximum investment is 5 million. So one possible combination is project 1 and project 2. Project 1 is 3 million, project 2 is 2 million, a total of 5 million. Another possible combination is project 1 and project 3, because the 3 million plus 2 million giving us 5 million. Then the other possible combination is project 2 and money market. This money can be invested in project 2 and also the money market. Then we have another last possible combination is project 3 and the money market. So out of these possible combinations, we are going to determine efficient portfolios. Efficient portfolios are the ones that promise a higher return than what we read in note number 3, part of the instructions. Number 3, the investment club requires a return of 14% per annum. So we are going to calculate the expected return from each of these portfolios. Expected return. We are going to calculate expected return from each of these projects. And out of these returns, we'll identify the efficient portfolios. Efficient portfolios. You understand, candidates? First of all, what is analyzed under the CML are efficient portfolios. An efficient portfolio is the one that promises a higher return compared to the return on investment. In note number 3 is 14%. So we are going to calculate the expected return from this portfolio, expected return from that portfolio, expected return from that portfolio, expected from that portfolio, and then we compare these returns with the 14%. The one that is less than 14% will be rejected. Then we'll proceed to analyze those that promise more than 14%. So what is the expected return for project 1 and project 2? Project 1 is 3 million. The forecasted, that we are reading from note number 4, the forecasted rate of return is 16%. So we are going to calculate the weight of each project. So here we have 3/5. Let me put it in decimals. We divide 3 divided by 5 as a decimal is 0.6. So the weight here is 0.6. 0.6 for this is 0.6 times project P1 rate of return, forecast rate of return is 16%. We add the weight for project 2, this project 2 will be 2 over 5, which is 0.4, times the forecasted rate of return for project 2, 15%. That will give us the expected return for the portfolio. We do the same for project P1 and P3. P1 and P3 is the same weight, 0.6 times expected return for P1 for this is P1 P3, yes, that is 16% plus 0.4 times P3. There you can see the rate of return is 22. Then P2, you can see candidates P2, the weight will be 2 over 5, converted into a decimal, that will be 0.4, times P2, 15. P2 expected return is 15% plus 0.6 times MM. MM return down there is 12%. Then moving on, candidates, to P3. 2 million divided by 5 million as a percentage is 0.4, as a decimal 0.4. P3 return 22% plus 0.6 times MM return 12%. So this will be equal to the expected return for the portfolios. So that will be equal to, so the first return here, 15.6%, convert it into percentage. Next, 18.4%. Next, 13.2%. Next, 16%. So candidates, these are the expected returns from these asset portfolios. So we need to decide, make a decision, which one are we going to analyze? And remember, we say that CML only analyzes efficient portfolios, and the benchmark is the 14%. So you can see this one here, 15.6%. This one is greater than 14%. So the decision is to accept. 18.4% is greater than 14%. Therefore, accept. 13.2% is less than 14%. Reject. 16% is greater than 14%. Therefore, accept. So that's the first thing to do, candidates, when making capital market line analysis, is to first of all identify the efficient portfolios. So that's step number one. Then you can see, candidates, we will choose that, and that. We have 3 acceptable portfolios. One is P1 and P2. Then we have P2 and P3. Then P3 and money market. 3 portfolios are acceptable. It is out of these 3 portfolios that we are going to calculate the alpha. And we have seen that alpha is equal to the expected portfolio return minus the required rate of return. We already calculated the expected portfolio return. This is the expected portfolio returns for these portfolios. So we have done this part, expected portfolio return for P1, P2, 15.6, P2, P3, 18.4, then P3 and money market, 16%. So our next working will be to calculate the required portfolio return for each acceptable portfolio. We are going to calculate required portfolio return. Required portfolio return. Candidates, you have read that this club, the investment club, requires portfolio return candidates. The minimum required rate of return of an acceptable portfolio refers to the minimum rate of return that an investor must achieve on their investment in order to meet their financial objectives and fulfill the investment goals. It, in other words, represents the level of return necessary to satisfy an investor's needs, aspirations, and financial obligations. So we are going to calculate the required rate of return, then we will come and plug it here for each portfolio. We are going to calculate for P1 and P2, P2 and P3, P3 and MM. We plug it here, then we'll calculate the alpha. So let us calculate the required rate of return. I'm going to work this out in form of a table. You can have a formula there for required rate of return, RP. Then I'll have the portfolios there. So the formula for required rate of return, candidates, is determined by adding the risk-free rate plus the premium over, this is premium, this is the premium, we divide by the standard deviation for the market, then we multiply this by the standard deviation for the portfolio. So that is the formula. 1 and P2, that's the first portfolio. The next efficient portfolio is P1 and P. Then lastly, we have P3 and money market. All right. So candidates, we have the risk-free rate from the question. We have the risk-free rate. What we do not have is the standard deviation for the market and the standard deviation for the portfolio. These two variables, we need to work them out. Do you understand? So first of all, you put down the formula. This is the formula for the required portfolio return. We need these variables: the risk-free rate, the premium, the standard deviation for the portfolio, and the standard deviation for the market. Let's begin with the standard deviation. Standard deviation for the portfolio. This one. This one is calculated by so that's the formula for the standard deviation of the portfolio of P1 and P2. P1 and P2, we have the weight. These are the weights. We had already determined the weights. So we square the weight. P1 weight is 0.6, square it. Then we square the standard deviation of P1. So we multiply by, we square the A to get the variance. That is the variance of P1 plus the weight of P2. The weight of P2, 0.4, we square it. Then we get the variance of P2 is 6 squared. 6 squared. Are you following? 6 squared, this one. You square the standard deviation from the question is 6. You square it. Then, and P2. That is the weight of P1 and P2. Weight of P1 and P2 is 0.6 times 0.4. All right, you multiply the weight of P1 and P2. Then you also multiply with the correlation coefficient, the correlation coefficient of P1, P2 from note number 5 candidates. From note number 5, the correlation coefficient of P1, P2 is 0.9. 0.9. Then we multiply the standard deviation of P1 and P2. Standard deviation of P1 and P2, standard deviation of going to give us the standard deviation for the portfolio. And that should be equal to, this should be equal to 0.6 squared times 8 squared plus 0.4 squared times 6 squared plus 2. This is 2 times 2 times 0.6 times 0.4 times 0.9 times 8 times 6. 49.536. So candidate, this is the variance, but we are calculating the standard deviation. So we are going to get the square root. This, we have to get the square root. That is the formula, square root of the variance. So this is the variance. So what is the standard deviation? So we get, this gives me 7.04. 7.04. So we've calculated the standard deviation of the portfolio P1, P2. Then we determine the portfolio of the market. We need to calculate the portfolio of the market, which is not provided within the question. Portfolio of the market. Now to calculate the portfolio of the market, here is the formula. The portfolio of the market will be equal to the square root of the summation of T's of RM minus expected RM. We square that. So candidates, this is the formula for the standard deviation for the market. So we are going to first of all calculate the expected return, RM, which we will get the figures from note number 2. Under additional information, we have 0.3, 0.4, and 0.3. Therefore, the expected forecasted rate of returns are 10, 15, and 20 respectively. And therefore, the expected rate of return here will be 0.3, 0.4 times 15 plus 0.3 times 20. This will be the expected return, which is equal to 15%. Then we are going to use this expected return there, so that the market return will be equal to, now substituting within the formula, the probability, the first probability is 0.3 times the 10%, is it 10? Yes, 10% minus the expected return, 15%. Then we add, the next probability is 4% into the return there is 15%, 15 minus 15 plus the last probability is 0.3 into the actual, their last one is 20, 20 minus expected 15. So this is the summation we are adding. We add the 3, then we square. We have to square them, square the variances, square the deviations. These are deviations. We square the deviations. Then we get the square root. So the first one here is 3.87. That is the standard deviation for the market, 3.87. So with that, candidates, we can now calculate the required rate of return for portfolio P1, P2, because we have the risk-free rate 12% plus the return. The return here is 15%, is 12%, divide the standard deviation for the market 3.87 times what we calculated here, standard deviation for the portfolio 7.04. So that is equal to that return. I get here 17.46. That is 17.46. That is the required rate of return for portfolio P1 and P2. We are going to do the same for P1, P3, P1, P3, P1, P3, P1, P3. P1, P3. We're going to use the same formula for standard deviation for the portfolio. So here we are going to have, this is P1, P3. So here we have P1, P3. So here we just change to 3, 3, 3. P1, P3, 3, 3, 3. All right. So what is the weight? The weight for portfolio 1 here is 0.6. 0.6. 0.6. We square it. All right. Then standard deviation for P1, standard deviation P1, looking at the information there, standard deviation P1 is 8%. We square 8% times 8%, not 8%, but 8 squared, 0.4, 0.4. The standard deviation for P3, standard deviation P3 is 10 times 10. Standard deviation P3 times 10. Okay, so we have 0 times the P1, P1, P2. So we have 0 point, the weight of P1 and P3, 0.6 times 0.4, 0.6 times 0. The weights of P1 and P3. Then the coefficient, correlation coefficient times correlation coefficient of P1 and P3 from the question, not number 5. Correlation coefficient of between P1 and P3 is 0.5. P1, P3, 0.5. Then times the standard deviation of P1 and P3, that is 8 times 10. 8 times 10. That is going to give us the amount that we require there. Is equal to 58.24. Get the square root. 7.63. That is the standard deviation. So you can now come here and work it out. It's 12. Is 12. Risk-free rate. 12 plus the return from the market remains the same. That is 15 over 12 minus 12 divided by dm. dm is constant. That is the standard deviation for the market, for the portfolio, which is 7.63. 7.63. 17.91. That is the required of return for that portfolio, 17.91%. These are percentages. Percent. 1%. Let's proceed to the last one. We want to calculate the portfolio standard deviation for the portfolio, for the last portfolio, which is P3MM. P3MM. P3MM candidates. We see the weights here. We are going to get the square root of this is P3 P3 This is M, 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 P3, M, MM. This is P3, correlation coefficient of P3, and M, standard deviation of P3 and M. That is what changes, but the formula basically remains the same for the standard deviation. So we get the square of, we square the weight of P3. P3 weight is 0.1 for times standard deviation for P3. Standard deviation P3 from the question, standard deviation P3 10% times 10% squared plus weight of the market MM 0.6 square it. Standard deviation of MM, not number 4, is 4. Standard deviation 4, so we have 4 squared plus 2. Weight of P3 0.4 times 0.6. This is times. Then the correlation coefficient of P3 and MM. P3 and MM is 0.15 times 0.15 times the standard deviations for P3. So we can calculate now. 24.64, get the square root, is equal to 4.96. That is the standard deviation for P3 mm. P3 mm. I come here and calculate it. P3 mm, P3 and mm. 12 risk-free rate 12% plus 15 minus 12 over market 3.87 times 4.96. 4.96. So the answer here is 15.84%. So these are the values candidates. That value, this value, and this value are the values that are required here. Those are the required portfolio returns for the 3 portfolios, P1 and P2. P1 and P2, 17.46, 17.46%. P2, this is P1 and P2, P1 and P3, that's correct. P1 and P3, yes, this is P1 and P3. P1 and P3, 17.91, 17.91%. Then lastly, we have 15.84%. 15.84%. So you're going to compare the two. 15, this is the expected return, minus the required return, 1.86. Next we have 18.4%, 0.4% minus 17.91%, it's positive 0.49. Then lastly we have 0.16. These are percentages. So you can see candidates we have analyzed. The question was, evaluate how Daniel Wekesa should invest the 5 million using the capital market line analysis in portfolio theory. So we started by saying that we ought to calculate the alphas for each portfolio. The alpha that will promise the highest return is the one to invest in, and therefore the best project, let me use that term, the best portfolio to accept using the capital market line to accept is P1, P3, P1 and P3, because it has the highest alpha. This one is negative 1.86%. This is 0.16. This is 0.49. So this is a portfolio to accept. Portfolio to accept. Then
Hi candidate, welcome to another session of manifested online classes. In this session, I want us to continue with the topic of earnings per share. In our first session on this topic, we defined what is earnings per share. We looked on the importances or basically the benefit of earnings per share, and also we were able to define some of the terms you need to know and basically which you'll come across during the computation of earnings per share. In this session, I want us to continue and look on the various types of earnings per share to be computed and disclosed by the listed companies. Remember, in our first session, we said that listed companies are expected or basically are required to compute and disclose earnings per share or two types of earnings per share in accordance with the International Accounting Standard number 33. So therefore, we have two types of earnings per share to be computed and also disclosed by listed companies. So we can say that there are two types of EPS to be computed and disclosed, by listed companies. So which are they? Number one, we have the basic earnings per share. Basic earnings per share abbreviated as BEPS. And number two, we have the diluted earnings per share abbreviated as DEPS. So therefore, what we're going to do as far as this topic is concerned, we're going to look on how these two types of earnings per share are computed. So let's start with the first one, and that is the basic earnings per share. Basic earnings per share, BEPS. BEPS. Now this is the earnings per share which is computed based on the profit for the current financial year, and also based on the shares issued and fully paid as at the end of the year. It is computed based on the profit for the year and also based on the number of ordinary shares issued and fully paid at the end of the year. So how do we compute these earnings per share? The basic earnings per share is computed by taking the profit, which is also known as earnings. Earnings attributable to ordinary shareholders. And this profit attributable to ordinary shareholders, this one is abbreviated as PATOS. And then we divide that with the weighted average number of ordinary shares, of which this one equally is abbreviated as what? As WANOS. WANOS for weighted average number of ordinary shares. PATOS is for profit attributable to ordinary shareholders. So therefore, that's how we compute the basic earnings per share. I want us to look on how we determine these two items, the PATOS and also ANOS, and we start by looking on how we determine the PATOS, that is the profit attributable to ordinary shareholders, and we can say that it is computed as follows. It is computed as follows. Computed as follows. So in this case, to compute the profit attributable to ordinary shareholders, we take the profit after tax reported by the company or reported by the group. The profit after tax is also known as the net income. This is also known as the profit for the year. Profit for the year. To this, we less the preference dividends. We less the preference dividend for the current year only. Preference dividend for current year only. For current year only. And then when computing the earnings per share for a group of companies, to this particular profit for the year, we also less the profit attributable to non-controlling interest. Profit attributable to non-controlling interest. But remember, in this case, I've said that this will only apply whereby we are computing the earnings per share for a group of companies. So if you're computing the earnings per share for a single company, definitely will not be having that profit attributable to non-controlling interest. So and then what we have down here is the profit attributable to ordinary shareholders. But equally, as far as these particular dividends are concerned here, as far as the preference dividends are concerned, there are points which are important for you to know, and I think I've already mentioned one of it, that the preference dividend which we less from that profit for the year should only be the preference dividend for the current year. If the company in a certain financial year happen to have paid dividends of 2 or more financial year, you don't less the dividends for all the dividends which were paid, but you only less the dividends, the preference dividends for that financial year. But equally, here we can have some additional points to be noted. As far as the computation of preference dividends are concerned. Number one, preference dividends on redeemable preference shares are not deducted from profit after tax. Preference dividends on preference shares which are redeemable, we don't deduct them here from the profit afterward tax. So the reason being is that, or the reason behind that is that the preference dividends on preference shares which are redeemable, those particular dividends are classified as part of the finance cost simply because these preference shares are redeemable. They are preference shares issued by the company, but they'll have to be redeemed after a given period of time. These preference shares which are redeemable to the company, this is like a debt capital. In fact, when the company is preparing the statement of financial position, redeemable preference shares are classified as part of non-current liabilities. So therefore, their dividends, we are saying they are classified as part of the finance cost. Finance cost is an expense. In arriving at this particular profit for the year, finance cost will have been deducted. That's why we are saying don't less preference dividends here in relation to preference shares which are redeemable. And if preference shares are redeemable, the examiner will give you some information about that. So number two is that if preference shares issued by the company are cumulative, then always we less their dividends from the profit from tax, whether or not those particular dividends were paid or what proposed. So cumulative preference shares, we can say dividends dividends on these shares, are deducted from profit after tax, whether or not paid, all proposed. So I think those are some of the key important points which are important for you to know as far as the computation of this profit attributable to ordinary shareholders is concerned. So let's look on how we compute the WANO's weighted average number of ordinary shares. Weighted average number of ordinary shares. Now this one is computed by taking into account the number of ordinary shares which were issued and free paid at the start of the year, and then we add the other shares which the company issued during the current year. So through that you get the weighted average number of ordinary shares. So it is computed by taking number of ordinary shares outstanding at the start of the year, So in this case, when talk about shares outstanding at the start, we are talking of ordinary shares issued and fully paid at the start of the year, taking ordinary shares outstanding at the start of the year, plus additional shares, issued in course of the current year. So that's how we compute now the weighted average number of ordinary shares. But now, how do we treat those particular shares which are issued during the current year? Now, first of all, the shares which the company issued during the current year, we broadly classify them into two. The shares which are issued at full market price and those shares which are issued at nil consideration. So we can say that shares issued during the current year, are broadly classified into two categories, or into two, broadly classified into two. Number one, we have the shares issued at full market price. Shares issued at full market price. And number two, shares issued at nil or no consideration. So these are first of all, and talk about the shares issued at full market price. These are those particular shares which the company will issue during the current financial year, and they are issued at full market price. Full market price means that these shares have been issued at a price equivalent to the market price per share. The market price per share is the price at which the shares of the company are trading in the securities exchange market. And these particular shares, for the purpose of computing the weighted average number of ordinary shares, these particular shares, what we do, we weigh them on time basis. So what do you mean by weighing those particular shares on time basis? Those particular shares, in other terms, will be multiplied with the proportion of time the shares were held during that year. If the shares were issued 6 months to the end of the year, then what you do, you multiply them with the proportion of time they were held. And then on the other hand, these particular shares which are issued at nil or no consideration, these shares are not weighted on time basis. We don't multiply these particular shares with the proportion of time they were held during that year, even if those shares were issued like 1 month or 2 months to the end of the year. So basically what that means is that to compute this weighted average number of ordinary shares, always we start with the balance brought down. What is the balance brought down? These are number of ordinary shares outstanding at the start of the year, start of the year. In other terms, these are ordinary shares which were issued and fully paid at the start of the year. And then in this case, we are saying you add the other shares which were issued during the current year. The shares which were issued during the current year are the ones which we are classifying into two. Number one, we have issue at full market price. And basically we are saying that those particular shares, we take the shares which were issued and then multiply those particular shares with a proportion of time they were held during that year. If, for example, the financial year of the company start on 1st of January, and end on 31st of December, and we are told on 1st of July, the company issued 2 million ordinary shares at full market price. So when adding those particular shares to the shares issued and fully paid at the start of the year, we don't add them as 2 million. But rather what we do, we take the 2 million shares, but we are saying multiply them with the proportion of time they were held. The shares were held for 6 months, 6 months out of 12. So whatever you get is now what you bring there. That's what you mean by weighing those particular shares on time basis. But on the other hand, those particular shares which are issued at nil consideration or free of charge, and a good example of this is a bonus issue. These particular shares are not weighted on time basis. So we have issue at nil consideration, and basically what we are saying is that these shares are not weighted on time basis. In other terms, you don't multiply them with a proportion of time they were held during that year. We don't multiply them with a proportion of time they were held during that year. So basically by doing that, we get something called the weighted average number of ordinary shares. So therefore, in computing the basic earnings per share, we take the PATOS, or we compute the PATOS, profits attributable to ordinary shareholders, and then we definitely divide that with what? With the weighted average number of ordinary shares. Weighted number of ordinary shares. Yes, so from there, once we proceed and look on how we treat different types of shares which are issued by the company during the current year, or basically we look on the reasons why the number of shares issued by the company at the start of the year changes. So therefore, let's look on that. So once we look on the causes of changes in number of shares, and that is specifically number of ordinary shares, shares. So the number of ordinary shares issued by the company at the start of the year may change due to a number of reasons. Number one is due to issue of shares. That is ordinary shares at full market price. So when talk about the shares issued at full market price, these are the shares the company issued during the current year at a price equivalent to the market price. Market price is the price at which the shares of the company are trading at the securities exchange market. Now, this particular shares, there is something we have said here. That always those particular shares are supposed to be weighted, or they are supposed to be multiplied with the proportion of time they were held. So we can say that these shares are weighted on time basis. I.e. they are multiplied multiplied with the proportion of time, they were held. Proportion of time they were held during that year. They were held during that year. So basically what that means is that if the company issued ordinary shares at full market price, maybe 6 months to the end of the year, what you do when computing the weighted average number of ordinary shares, you'll take those particular shares issued at full market price. You'll take the issue at full market price, issue at full market price. If the company issued like 2 million ordinary shares, which were issued 6 months to the end of the year, multiply them with the proportion of time they were held during that year. So number 2, we have issue of bonus shares, issue of bonus shares, So bonus shares, these are those particular shares which are issued to the existing shareholders of the company, but free of charge. Now, those particular shares are assumed to have been issued at the start of the year simply because these are the shares which the company will issue, but the company do not receive any additional resources, do not receive any amount of money. So the profit generated by the company during that year is generated using the same resources. And therefore, in this case, we assume that these particular shares have always been in issue. So we assume they were issued at the start of the year, and therefore, for the purpose of computing weighted average number of ordinary shares, we don't weigh them on time basis. So we can say that these shares are not weighted on time basis. These shares are not weighted on time basis. So the reason why they are not weighted on time basis is because these particular shares do not generate any additional resources, meaning that the profit generated by the company during that year, that profit is generated using the same resources. And actually, therefore, we assume that these particular shares have always been in issue, Equally, if we are given financial information about the previous financial year, we equally assume that those particular shares had been issued at the start of the previous year. Like, assuming you come across a question for earnings per share, and you're given information about 2 years, the year 2022, the year 2023, and during this particular year, maybe like 6 months to the end of the year, assuming the year is ending on 31st of December, 31st of December there, 31st of December, we may be told that on 1st July of that year, which is now 6 months to the end of the year, the company made a bonus issue. So we are saying that these particular shares are assumed to have always been in issue. In other terms, we assume that these particular shares had been issued not at the start of this year because we are given 2 years, but at the start of 2022. So what is the implication of that particular assumption? Number 1 is that when computing the earnings per share, or when computing the one-offs for the year 2023, those particular shares, we don't multiply them with the proportion of time they were held during that year. We don't multiply them with 6 all over 12 because we are saying these shares are assumed now to have been issued at the start of the earlier reported period, at the start of the year 2022. So therefore, these shares in this year, we don't weigh them on time basis. And number 2, bonus shares are also used to restate, to adjust the earnings per share of the previous year. So because when the earnings per share for this year was being computed, these bonus shares were not used, but we are saying we assume they were issued at the start of 2022. So therefore, what we do in that case is we need to restate, we need to adjust the earnings per share of the previous year. So how do we compute this adjusted or restated earnings per share? And that is basic earnings per share of the previous year. That is now the year 2022. So what we do, we take the PATOS, the profit attributable to ordinary shareholders for 2022, and then we divide that with one-offs. We know how to compute one-offs for 2022. But now to this particular one-offs, what we do, we add the bonus shares issued in the year 2023. Simply because we are saying these shares were not issued in this year, but we are saying they were we assume they were issued at the start of 2022. So what you do, you have to adjust. You have to restate or to compute afresh the earnings per share of the previous year. So that's how we deal with the bonus shares. So the other type of issue, number 3, or the other reason why the number of shares issued at the start of the year may change is due to something called a share split. A share split. So when talk about a share split, this where the company subdivide one share into 2 or more shares of a lower par value. One share will be subdivided into 2 or more shares. For example, in this case, you can be told that the directors of the company have decided to split one share into 4 shares. Meaning that if you held one share before the split, after the split, you'll be holding how many shares? You'll be holding 4 shares. But it is obvious that the additional shares which you're going to or basically the additional shares which you are going to have as a result of the share split, like in this case, you will have 3 additional shares. These particular shares you don't pay for. You don't pay for these particular additional shares. In other terms, you can say these are like additional shares which will be issued to you free of charge as a result of what? The share split. And therefore, the additional shares which are issued by the company as a result of the share split, they are treated as an equivalent of the bonus shares. So we can say that the additional shares issued as a result of the split, shares issued as a result of a share split, are treated as an equivalent, of bonus shares. Are treated as an equivalent of bonus shares. So if they are treated as an equivalent of bonus shares, it means that these particular additional shares issued as a result of the share split during the current year in computing the weighted average number of ordinary shares, those shares we don't weigh them on time basis. And number 2, we also have to use them to restate or to adjust the earnings per share of the previous financial year. And then from there we have shares, or the other reason why the number of shares issued at the start of the year may change, we have shares issued on conversion of convertible securities. Conversion of convertible securities. When talk about the convertible securities, these are securities issued by the company like debentures, like bonds, and which are convertible, meaning that they can be converted into ordinary shares of what? Of the company. Once the company has issued ordinary shares, as a result of the holder of such securities converting them into ordinary shares, then the ordinary shares issued are treated as an equivalent of the shares issued at full market price. So therefore, we can say that these shares are treated as an equivalent of issue at full market price. Meaning that the shares which are issued on conversion of convertible securities, for the purpose of computing the weighted average number of ordinary shares, what we do is that we multiply them with the proportion of time those particular shares were held during the current year. Yes, number 5, we have shares issued as a payment of purchase consideration, as payment of purchase consideration, payment of purchase consideration. So these are the shares now which will be issued by the company under something called a share-based payment. So the company, for example, has acquired a subsidiary. The company has bought some goods. The company has been provided with some services, and the company will want to pay for those good services through by issuing its own shares. So the ordinary shares which are issued here on conversion, then equally they are treated as shares issued at full market price. So mean that those particular shares will be weighted on time basis. So we say that they are weighted on time basis. They are weighted on time basis. In other terms, these particular shares will be multiplied with the proportion of time they were held during that year. And here we consider now these particular shares not from the date they were actually issued, but from the date the shares were supposed to be issued. For instance, if a company like a parent company acquires a subsidiary, the parent company can pay the purchase consideration on acquiring this particular subsidiary through issuing its own shares. So we assume that the parent company acquired the subsidiary on 1st of January. That is the date of acquisition, which is abbreviated as DOA. But the shares which were to be issued to pay the purchase consideration, maybe they were issued on 1st of March. So in this case, we are saying that these particular shares are taken into account from the date of acquisition, because that is the date when the shares were supposed to be issued. So that is for the purpose of determining the proportion of time you are going to use in weighing those particular shares. Then number 6, we have shares issued on exercise. Shares issued on exercise of a stock option. Shares issued on exercise of a stock option. So first of all, what is a stock option? A stock option, basically this is a privilege, or in other terms, it is a right which is given to the employees of the company to buy the company shares in future at a price which is below the market price. So once the employees have been given such an option or such a right, and they have exercised that right, it means that they have bought the shares of the company, but at a price below the market price. So maybe first of all, we can say a stock option, which is also known as a share option. A share option is a privilege. To company employees. To do what? To buy company shares at a price below market price. At a price below market price, or basically at a price below the fair value. Now, anytime the company issues shares at a price which is below the market price, then it is assumed that some of the shares were issued at full market price, whereas other shares were issued at nil consideration. So we can say some of the shares are assumed to be issued at full market price, and others at nil consideration, Nil consideration basically means that these shares are issued as bonus shares. Bonus shares are those particular shares which will be issued free of charge. And therefore, anytime the shares have been issued to the employees of the company as a result of exercising the stock option, those shares, we split them into two main components. We determine the shares which were issued at full market price, and also the shares which were issued at nil consideration. So let's look on how we do that particular split. So these shares issued at or in exercise of stock option, we are saying number 1, we have those particular shares issued at full market price. We can just refer to them as issue at full market price. Issue at full market price. So how do we determine these particular shares? One, what you need to do, or basically what we do first of all, is to compute the amount received by the company. The amount received by the company will be equal to the shares which were issued to the employees of the company times the price they were to pay per share. The employees were to pay a price of how much per share? So that will give us the amount received by the company, and then divide that with the average market price during that year. So this will give you the shares issued at full market price. Then you have to recall the rule that anytime the company issues shares at full market price, the rule is that you weigh those shares on time basis. You multiply those particular shares with the proportion of time they were held during that year. If they were held for 6 months, you multiply that with 6 months out of 12. If they were held 3 months, you multiply that with 3 out of what? 12. And number 2, we determined the bonus element. Bonus element, these are shares which are issued free of charge. And this is a formula which we use. First of all, take the total shares issued, total shares which were issued, the shares which were issued to the employees of the company, and then deduct issue at full market price. Issue at full market price. So the shares which were issued at full market price. And the shares which were issued at full market price, we have said this one is determined by taking amount received divided with the average market price per share. And then this particular bonus element, because these are shares which are issued free of charge during the current financial year, these particular shares, we don't do what? We don't weigh them on time basis. And then number 2, if you're given information about the previous financial year, you also have to restate the earnings per share of the previous year using these bonus shares, or using that bonus what? Element. That's how we deal with the stock option, specifically when computing the weighted average number of ordinary shares. Finally, I want us to look on the last concept, which is very, very common. And this is a concept which is tested in all questions for earnings per share. And that is the concept of the right issue. Now, what is a right issue? A right issue, first of all, this is the issue of additional shares to the existing shareholders of the company at a price which is below the market price. In other terms, we say that here the company issues shares to the existing shareholders of the company at a discounted price, to the market price. If the shares in the securities exchange market are trading at 20 shillings per share, the company can issue additional shares to its existing shareholders at a price of 15. So we can say that this is issue of additional shares to existing shareholders at a price below the market price. Below market price, at a price below market price, MP for market what? Price. And the concept which I've explained here regarding the stock option will also apply here. Because these particular shares are issued at a price which is below the market price, it is assumed that some of the shares are issued at full market price, whereas other shares are issued at nil what? Consideration. Therefore, those particular shares which are issued by the company during the right issue, just like what you have done in case of a stock option, those particular shares, we split them into 2 components, into shares issued at full market price and the bonus what? Element. But in terms of now how we split these shares here, there is a slight difference from what you have done there. So let's look on how we split these particular shares. The shares which are issued during the right issue. During the right issue, we are saying those particular shares will be split into 2 components. One, the issue at full market price. To compute these particular shares issued at full market price, first of all, you need to compute how much amount was received by the company from the existing shareholders. You take the shares which were issued to the existing shareholders, divide that with what? Or basically multiply that with the price which was paid per share, and then you multiply that with something called the theoretical X-rate price. Theoretical X-rate price. I'll be able to explain later on what is theoretical X-rate price, and also we look on how we compute the same, because that is a price which the examiner will not have given you, theoretical X-rate price. And then these particular shares, because they are issued at full market price, our rule remains that those particular shares, you have to multiply them with the proportion of time they were held during that year. And then number 2, you determine the bonus element. Bonus element, these are shares issued free of charge. And the formula for which we have used here also applies here. So compute the total shares issued, total shares which were issued, and then minus issue at full market price. Issue at full market price. Issue at full market price. And remember, to compute the shares issued at full market price, this is a formula which we apply here. So amount received divided that with the theoretical X-rate price. And these particular shares here, we don't weight them on time basis, not weighted on time basis. And equally, if we are given information about the previous financial year, you also use those particular bonus shares, the bonus element, in terms of restating the earnings per share of the previous year. So I want to explain what is theoretical X-rate price here. Theoretical X-rate price. Now, theoretical X-rate price, in very simple terms, this is the expected market price per share after the right issue. The price at which the shares of the company will be trading at in the securities exchange market after the right issue. So in very, very simple terms, this is the expected market price per share, expected market price per share after a right issue. After a right issue. After a right issue. So, and equally I've said this is a price which the examiner will not have given you. This is something you have to compute. So we can say it is computed. It is computed as follows. It is computed as what? As follows. As follows. So in this case, what we do here to compute the theoretical X-rate price, first of all, we take into account the shares which were held before the right issue. Before the right issue, take into account the shares which were held, and then what you'll do, you multiply those shares. You multiply those shares with the market price per share before the right issue. Before the right issue. So because in most of the cases you'll be told that if, for example, you held, or a shareholder held like 10 shares before the right issue, 10 shares before the right issue, then during the right issue, such a shareholder will be issued with 2 shares. So in this case, when we talk about the shares which were held before the right issue, we are talking of the 10 shares, which a shareholder held 10 shares, but those shares were trading at a price of how much? Multiply the 2. And then you take the shares which were issued during the right issue, like in this case, there were 2. Those shares were issued at an amount of how much? Were issued at a price of how much? And that price we refer to it as exercise price, EP. So multiply the 2. And then what you do, you come and you get the total here. The total shares which will be held after the right issue, and then you get the total value here. So let's assume that here we have gotten a value of B, and here we have gotten a value of A. So to compute now the theoretical X-rate price, we take B divided by what? By A. So that will give us now the theoretical X-rate price. So that is the price now which we use up there in terms of computing the shares which were issued at full market price. So I've said that this particular concept here, the concept of the right issue, is actually tested in almost all questions for earnings per share. If you go through the past papers, specifically those particular questions from this topic, you'll be able to see almost all questions are testing this particular concept of the right issue, and it's because majority of the students who sit for this paper, they have a challenge when it comes to computing the theoretical X right price and also splitting the shares which were issued during the right issue into those two components, into the shares issued at full market price and also the bonus the bonus element. So basically that's what you need to know. Those are some of the reasons why the number of ordinary shares issued at the start of the year will change. So you have now to know how do you deal with those different types of issues, specifically when computing the earnings per per share, or the basic earnings per share. Here is today's assignment. Question 1. What are the different types of earnings per share that companies may report, and how do they differ in terms of calculation and relevance to investors? 2. Discuss the significance of basic EPS and diluted EPS and explain when each type is typically used in financial reporting. 3. How does the treatment of potential ordinary shares differ from basic EPS and diluted EPS calculation, and how does this impact the interpretation of its EPS figure? The last question, the next question, number 4. What factors can lead to changes in number of ordinary shares outstanding for a company, and how does these changes affect the calculation of EPS? The other question, discuss the impact of a stock split and reverse split on the number of outstanding shares and the EPS calculation. The last question, how does events such as share repurchase, issuance of new shares, and conversion of convertible securities influence the number of ordinary shares outstanding, and what implication does this changes have for EPS? So for now, I want us to stop at that point, but once we come back in our next session, or we meet in our next session, we're going to look on an illustration question based on a past paper question regarding how to compute the basic earnings per share. So see you in the next session.
Hello everyone and welcome to the lesson. Today we are going to introduce a new chapter known as Accounting in the Public Sector. This topic has 3 subtopics, the first one being features of public sector entities, number 2, structure of the public sector, 3, regulation and oversight, 4, objectives of public sector financial statements and standards, the IPSAS, 5, accounting techniques in public sector such as budgeting, cash, accrual, commitment, and fund accounting. These are the 5 subtopics. We begin by looking at the features of public sector entities. Features of public sector entities. Now, in studying the features of public sector entities, we'll be comparing these features with the private sector. And candidates, the public sector entities, which are often referred to as government-owned or government-controlled entities, differ from private sector entities in several ways. One way in which they differ is ownership and control. Another way is on the basis of the purpose and objectives. They also differ in terms of funding and capital structure. There is also a difference on the basis of profit motive. So we are going to study these differences or features in today's lesson. So by the end of this lesson, you should be able to discuss the features of public sector entities as compared to the private sector. So the first basis or feature of public sector entities is ownership and control. Ownership and control. Ownership and control. Now, candidates, public sector entities are owned and controlled by the government. All right? Whereas the private sector entities are owned and controlled by private individuals and organizations. So one way or feature of a public sector in comparison to the private sector is ownership and control. Public sector entities are owned and controlled by the government, whereas the private sector entities are owned and controlled by private individuals and companies. And candidates, in the private sector, decisions regarding operations, investments, and even strategies may be subjected to government oversight. May also be subjected to government regulations. So they are controlled by the government. Number 2, purpose and objectives. Purpose and objectives. Now, candidates, in the public sector, the entities in the public sector typically serve the public interest, and the aim is to provide essential services and goods to its citizens, such as education, healthcare, infrastructure, defense, and so on. That's the objective of the public sector entities, is to provide public goods and services. Whereas private sector entities primarily operate to generate profits for the owners or